Welcome, focused learners, to this explainer. Most traders just stare at their screens and see absolutely nothing but chaotic market noise. But today, we're taking a highly systematic, data-driven approach to actually extract a precise, executable roadmap from one of the most powerful data sets on the planet. The premise we're starting with today is pretty simple. Most traders look at this data and see noise, but professionals see a roadmap. We're talking about the CFTC's Commitment of Traders Report, or the COT report. It's basically the ultimate truth detector. Think of it as the only free, government-mandated window into the positioning of the largest capital pools on Earth. Every single Friday, this report reveals the exact hands of the banks, the hedge funds, and the public. Honestly, the difference between those who lose money and those who make it isn't raw intelligence. It's just having the right framework to decode this data. Here's our game plan for today. 1. The 3 market players. 2. Calculating key metrics. 3. High-probability confluence setups. 4. The 3-legged reversal. And 5. Weekly execution checklist workflow. Let's jump right in. Section 1. The 3 market players. Knowing exactly who to follow and who to fade. Let's look at the stark contrast between these two massive market forces. On one side, we've got the physicals, also known as commercial hedgers. Now, these players aren't guessing where the market will go. They have a strict obligation to protect real assets. When a gold miner sells a futures contract, well, that gold actually exists in the real world. This isn't an opinion, it's an obligation. So our strategy is to copy their direction. Opposing them, we have the momentum crowd, or managed money. They don't have physical assets, they just have a mandate to chase price, strictly trend following. And hey, it works beautifully for them, right up until it doesn't. When their crowded trades finally unwind, it is incredibly violent. So we want to fade their conviction right at the extremes. And that brings us to the third bucket, the public, the non-reportables. These are the emotionally driven, consistently late participants. They enter last and they exit last. The absolutely crucial point here is this. When the public finally aligns with the momentum crowd and shows up at historically extreme readings, their presence confirms the market move is totally exhausted. When you see that happen, your trade setup instantly goes from high probability to highly urgent. Moving on to Section 2, calculating key metrics, and moving beyond raw contract numbers. Okay, a massive mistake traders make is looking at raw net positioning. A net long of 90,000 contracts is totally meaningless without historical context. If the 3-year range is 50,000 to 150,000, then 90,000 is just neutral noise. But if the range is 80,000 to 95,000, that exact same 90,000 is a screaming extreme. The solution? Calculating the positioning percentile. Step 1, take the current net position. Step 2, subtract the 3-year minimum. Step 3, divide that by the overall 3-year range. Step 4, multiply by 100. It seems super simple, but this brilliant little calculation converts raw, messy data into a clean, actionable score between 0 and 100. Now, while the percentile tells us where the market is, we also need to know where it's going. Enter the weekly delta. This measures the momentum acceleration of these positions. We're tracking 2 things here, the percentile rank of change, which needs to be over 90, and the z-score, which needs to be over 2.0. If the physicals are already at an extreme and their delta suddenly crosses these high thresholds, that confirms they aren't just sitting on their hands. They are actively accumulating or distributing with intense, unusual conviction. Let's transition to Section 3, High Probability Confluence Setups, identifying dual extremes. This is the holy grail of COT analysis, the immovable object meeting the unstoppable force. The absolute strongest signal happens when the physicals and the momentum crowd hit opposite extremes simultaneously. Imagine this. Physicals are heavily hedging long, acting as the anvil, while the momentum crowd is completely euphoric and fully positioned short, acting as the wave. At that point, there is literally no one left to sell. These dual extremes might only happen 2 or 3 times a year per market, but when they do, it's a massive red flag that the path of least resistance is about to violently reverse, often kicking off a multi-month trend. Moving right into Section 4, the 3-legged reversal, using the Shapiro adaptation for timing. So here is a brutal truth you need to know. Markets can remain at extreme percentiles for weeks, sometimes months, while the price just keeps running against you. You absolutely cannot enter on positioning alone. Jason Shapiro showed us that we need a specific catalyst, structured as a chronological 3-legged reversal. First, leg 1, the positioning extreme, meaning the structural fuel is totally spent. Then, leg 2, a news failure, where an expected market reaction completely collapses. And finally, leg 3, a technical violation, where a structural price level is definitively broken.
Let's really zero in on leg 2, the news failure, because this is the piece traders often struggle with. A scheduled, high-impact news event drops. Logically, the price should shoot in the direction of the crowded trade, right? And maybe it does initially, but then it completely reverses within that exact same trading session. Why does this matter so much? Because it brilliantly proves that the momentum crowd has zero capacity left to absorb flow. Every last buyer or seller is already in, and the market simply cannot sustain the trend anymore.
Which brings us to our final section, the weekly execution checklist workflow. Time to put all this theory into practice.
We're going to take all that mathematical theory and turn it into a ruthless, professional weekly schedule. This is the macro flow of your week. It kicks off on Friday when the CFTC report drops. Saturday is your deep preparation day. And Monday through Thursday, that is your active window for execution and market monitoring.
All right, Friday's checklist. This is strictly analytical. You aren't trading, you're crunching numbers. First, export the disaggregated report for your markets. And remember, focus on commodities and currencies where physicals actually play, not equity indices. Calculate those positioning percentiles, calculate the weekly deltas to check momentum, and record the open interest. Most importantly, flag any single market where the momentum crowd percentile is above 80 or below 20. Those right there are your targets for the week. Now it's Saturday. The desk is quiet. You take those flagged markets and you review the upcoming economic calendar. You're actively hunting for potential news failure candidates. Inventory data, central bank decisions, jobs reports, whatever. Once you know when that news is scheduled to hit, you open your charts and mark structural technical lines in the sand. Swing highs, swing lows, moving averages. You are essentially building a trap. Monday to Thursday, you execute. But listen, execution here actually means extreme discipline. You monitor those flagged markets right as the news hits. Watch for that initial move in the expected direction, and then wait for the full reversal pattern within 60 minutes. Finally, wait for the closing price to confirm a technical violation of those levels you drew on Saturday. You enter the trade only when all 3 legs of the Shapiro adaptation perfectly align. Extreme positioning, plus a news failure, plus a technical violation, that is the highest probability setup in COT trading.
Before we wrap up, a really crucial reality check. The COT report is not real time. The report that gets released on Friday actually reflects positions from the previous Tuesday. Price can move a lot in 3 days. So COT data dictates your broader, higher timeframe market bias. It tells you exactly where the smart money is parked. But lower timeframe price action, your technical violation, that is what dictates your actual entry trigger.
Well, we've covered the players, the math, the confluence setups, and the exact weekly checklist. It's a rigorous process for sure, but it is exactly what separates the professionals from the gamblers. So I'll leave you with this final thought. Are you going to keep trying to navigate market noise with the emotional public, constantly showing up late to the party? Or will you take the time to run the percentiles, patiently wait for those 3-legged reversals, and start trading the roadmap of the smart money? The data is sitting there waiting for you every Friday. Thanks for watching this explainer, and keep learning out there.